The descriptor alternatives encompasses a broad mosaic of public and private market asset classes and strategies. If we start with asset classes, these range from highly liquid commodities and currencies to less liquid asset classes such as private equity and debt, real estate, and infrastructure. Turning to alternative strategies, these can provide the ability for investors to express the full range of investment insight by implementing both long and short positions in portfolios across and between various asset classes, rather than being constrained to long-only positions in a traditional investment solution. Alternatives provide investors with exposure to a broader set of risks and returns than can be accessed through investments that rely only on traditional public equity and fixed income solutions. More breadth is synonymous with greater portfolio diversification, which can help mitigate equity drawdown risk and smooth out the trajectory of returns. Alternatives are complements, not substitutes. Our challenge is to determine how best to combine all these opportunities into a more optimal portfolio. Each alternative offers something distinct and complementary. Private equity offers higher expected returns relative to public equity, albeit at the cost of less liquidity. Real estate and infrastructure offer the possibility of enhanced income as well as a greater ability to hedge inflation risks. And multi-asset strategies can provide diversification benefits that help smooth the profile of long-term expected returns. Not every alternative will be right for all investors, but once we have determined how to efficiently increase investment breadth by adding alternatives, long-term portfolio outcomes are likely to be enhanced. There's no one-size-fits-all portfolio. Investors will differ in the amount and manner in which they allocate to alternatives, depending upon their goals, their sensitivity to various risks, and their starting portfolio allocations. Investors with a focus on core fixed income solutions can look to alternatives as a way to diversify interest rate and inflation risk and to enhance expected income and returns. And multi-strategy alternatives can provide these investors with a diversifying source of return without any significant increase in portfolio volatility. Equity-centric investors may allocate to private equity or real estate to enhance expected returns. Real estate can also generate predictable income and provide these investors with another opportunity to hedge inflation risks. And multi-asset strategies can be utilized to diversify macro growth risks typically prevalent in an equity-centric portfolio.